Financial markets remain on a high alert due to the realistic scenario of the global recession. With a gloomy mood, investors are looking forward for the US NONFARM payrolls, which are due on Friday. This is certainly the highlight of the week, which will make a serious impact both on the market sentiment and on the Fed's policy decisions. Let's discuss this and other events that will take place in the second half of the first trading week of 2023. On Thursday, January 5, the ADP payroll processor will present its employment data for the U.S. private sector. Recently, readings in the ADP reports have differed considerably from official data published by the U.S. Labor Department, so you are strongly recommended to avoid making a hasty conclusion from this report and wait until the next day, January 6. In the early European session, traders will respond to the news from Europe. The euro-dollar pair has been trading with a high volatility lately. The euro is unwilling to give in to the firm US dollar. Analysts warn of negative data on the manufacturing sector of Germany, the powerhouse to the whole European economy. Interestingly, Germany, alongside other EU countries, has frequently reported better than expected macroeconomic data, as a pleasant surprise to investors. In the last report, Germany's factory orders increased to 0.8%, much stronger than a projected 0.1% uptick. This time, analysts predict a contraction to 0.5%. Traders were amazed by a preliminary inflation data for Germany released yesterday. The CPI was much lower than an expected 9.1% growth. The annual inflation rate dropped to 8.6%. Besides, inflation data for France also came as a nice surprise. Meanwhile, traders are in suspense, anticipating flash estimates for the 19 countries of the Eurozone. Analysts suppose that inflation in the Eurozone could remain almost flat at 10% on a year in December. Still, market participants are in no hurry to price in the expected data. They prefer to wait until the actual CPI is unveiled. The odds are that the actual CPI will be much lower than expected. Still, the market is likely to give a muted response to the inflation data. No wonder traders are focused on the current economic conditions and the outlook for the top global economy. They will be able to evaluate the state of affairs in the US economy through the labor market, and this time analysts predict more than 200,000 jobs in the US private sector, like in a few previous months. Remarkably, for a few times, NONFARM payrolls have looked much stronger employment than in the consensus. It means that the labor market is overheated. According to the latest statistics, 1.7 jobs account for one employer. Under such competitive conditions, many American firms have to raise wages, which in turn trigger further inflation acceleration. Indeed, labor costs are included in retail prices of goods and services. To sum up, another strong employment report will confirm the Fed's intention to go ahead with the rate hikes. And this is certainly bullish for the US dollar. The economic outlook for the US will be clouded, which will keep investors on their toes. The survey by the Institute for Supply Management will assure investors to seek shelter in a safe haven assets. The ISM manufacturing PMI will prove that the factory activity is losing momentum. The consensus suggests that the index could have slipped to 55 points, but the actual reading could be even lower at 53 points. In recent remarks, former Fed policymakers pinpointed the signs of an inevitable economic slowdown in the United States. Stock investors are already responding to such forecasts by sell-offs and transferring their capital to safe haven assets, in particular the US dollar and gold. And you have watched Forex Trader Calendar on InstaForex TV channel with me, Kate Stichina. We wish you profitable trade and see you soon on our channel.